After a violent 20% decline, the US stock market has recovered over half of its losses following Donald Trump's announcement of a pause on his tariff policies. But at the same time, there are signals underneath the surface telling us it could be dangerous to place too much trust in today's stock market rally too quickly. One of these signals is the home building sector that has been underperforming the rest of the US stock market ever since Donald Trump was elected. We use the home building sector in our analysis because it's a fantastic way to gauge liquidity and economic conditions. Home building stocks only perform well when many people are buying homes. And for that to happen, we need two things happening simultaneously. First of all, banks need to be lending money abundantly. If banks are not lending, people cannot buy homes. Secondly, consumers must be optimistic and in a strong shape. If people are in a bad financial shape and pessimistic about the future, they're not going to be buying homes. Both of these factors are great indicators of how strong economic growth is going to be in the future. And one of the best tools to evaluate these metrics is the home building sector. This is why every single durable stock market recovery that we've seen over the last decade has happened along the side of an outperformance in the home building sector. While stock market recoveries that have occurred alongside an underperforming home building sector, like here in March of 2022, have generally failed to last and ended up seeing stocks making lower lows. Today, as we mentioned earlier, while the stock market rally we've seen so far this year has been without a doubt very powerful and intense, it has not been accompanied by an outperformance in the home building sector. In fact, we can make out a pretty clear divergence between these two lines, which paints a very different picture to anything that we saw between late 2022 and late 2025. This strong performance in the home building sector was suggesting liquidity was plentiful and that the US consumer was strong. Today, we have quite the opposite picture where home building stocks are actually telling us there's potentially still underlying economic weakness. So does this all mean that we should be pouring our life savings into S&P 500 put options, betting on an outright collapse of the market? Not exactly. If you've been watching our videos during this panic, you'll know that we've expressed the view that we expect this correction will end up being a buying opportunity for stocks and that we could see the S&P 500 rally higher in the rest of 2025 right now. But what this divergence tells us is that we should stay level-headed and manage our expectations. Investor sentiment has flipped from "this is going to be the end of the world" to "Trump is going to take the stock market to the moon" in just a couple of weeks' time. Giving into these kinds of narratives is why most retail investors sell the market at the bottom and buy the market at the peaks. And this divergence tells us that there's still some underlying concerns regarding the economic outlook that could be suggesting we won't necessarily be seeing stocks move in a straight line back to all-time highs, as many people are talking about right now. Although this scenario is definitely possible, in the context of underlying economic weakness, we don't think this is the highest probability scenario right now. Now, you might be wondering, what is the highest probability scenario here? Well, if we rewind to 2011, we see the stock market also experienced a rapid 20% decline as a result of the European financial crisis that was unfolding at the time. Similar to today, the home building sector actually anticipated that decline ahead of time, providing an early warning signal. Now, right after the initial panic moved down, the stock market rallied aggressively by about 10%, but this was happening alongside an underperformance in the home building sector, suggesting there was still underlying economic weakness at the time. And indeed, following the initial bounce, stocks turned back down and chopped around this zone for a couple of months. Eventually, all those concerns cleared up, and the US stock market was able to make a powerful recovery alongside an outperforming home building sector, suggesting that all of the economic concerns from the European debt crisis had indeed cleared up, and that the stock market was actually ready to rally higher. Fast forward to today and the situation isn't entirely different. Although again, it's certainly possible that stocks recover straight back to all-time highs, we think the higher probability scenario right now is that markets remain quite choppy as they continue to digest all of the recent economic developments, all of the massive economic shifts that we've witnessed over the last couple of months. If we overlay the price action of the US stock market from 2011 on top of what has been happening today, first of all, we do see some similarities in the behavior of price, and it also shows us that a real bottoming process can take some time before the stock market actually resolves higher in a durable fashion. So as a result, we've actually used the recent strength in stocks to book profits on some of the trades that we initiated on our website during the market panic. We booked a 7% profit on SFM, we booked a 10% profit on ADMA, and we closed our position on UAMY for a 78.5% profit. In terms of new trade initiations, we are being extremely selective. We're looking for stocks that are resilient or completely disconnected from tariffs, or even better, stocks that are benefiting from the trade war. That's the case for PPTA and Spotify that we've initiated trades on. But overall, we still have a much more conservative approach to our trade additions compared to 2024. When we start to see an improvement of the technical structure and some signs of underlying economic strength, we'll quickly be ramping back up our level of